There are a lot of places where you can invest your money. And as you browse the internet or jump on YouTube, you're going to hear so many different ideas. You may not have a good idea what direction should you go. So this video will definitely help you out. I'm going to list the top 12 investments to avoid, and I'll give a quick reason behind each. All right, before we dive in, if you guys like videos on investing in finance, please hit that like button. And if you want to see more videos like it, please hit that subscribe button. Here at Tykr, we're all about clear, confident investing. Number one, penny stock. So a penny stock is any stock, this is US dollars, any stock that is $5 or less. Now here are the percentages. Any stock that is between $0 and $5, there's a 99.9% chance will never break out past $5. And any stock between $5 and $10, there's a 90% chance it'll never break out past $10. The reason is large institutions lose confidence and lose interest, so they no longer invest in the stock. Large institutions are the entities that really move share prices up and down the most. Sure, retail investors like you and I can move share prices a little, but it's mostly large institutions. And again, they lose interest and confidence, so they run the other direction. They look for larger companies with a larger market cap. So penny stocks are a trap. Keep in mind, penny stocks in the US, $5 or less. And of course, you're flirting with that territory if it's between $5 and $10. I do understand that other countries might have dollar amounts that can fall in that range, but just do your homework. What I like to do is look at that 5-year chart in Tykr to see if the stock beats the market, if it's 80% or more. 80% is really the benchmark of the S&P 500. Anyway, number two, IPO stocks. Initial public offering. There's also DPO, which is direct public offering. Essentially, they're the same thing. It's a stock that's going public. Now, in most cases, IPO stocks are looking for ways to raise money. There are a lot of cases where stocks run out of ways to bring in funds. Banks no longer give them loans. Venture capital pretty much looks the other way, and private equity lasts them out the door. So what do? Well, they go public to raise money from retail investors like you and I. Unfortunately, most retail investors don't know the difference between a good stock and a bad stock, and they're counting on that. So they want to raise money from us. So be very careful with IPO stocks. What I tell people is try to wait 4 consecutive quarters to make sure the company is, number one, it's on sale in Tykr, and number two, it's consistently increasing that net income and EPS. That's the key factor. It's profitability. That's the most important thing with business. So again, I like to wait 4 consecutive quarters just to make sure it's a strong enough company, and then I will invest. Okay, number 3 would be private companies. It can be very tempting to invest in a private company. This is a company that's not a public company. It's not a stock. There are people out there that are looking for that next new Facebook or Google or Uber or whatever, and it's very hard. So for context there, venture capitalists will invest in about 100 companies, but only expect to make money on 5. That's a 5% win ratio. And they have the capital to take the risks. Most of us, retail investors, we don't have that kind of capital. We don't have tens of millions of dollars sitting around, and we're okay with just waking up the next day being like, well, we just lost $5 million, not a big deal. That's not the case. So private companies, it can be tempting, but I like to invest in stocks because they have proven to play in the big leagues. They have good financials, they're strong enough businesses, they're well established. It's a lot less risk. So just be very careful with private companies. Number 4 would be your friend's business or your sibling's business, or it could be a cousin's business. Sure, you may like and you may love that person, but it doesn't mean you should give them your money. In most cases, businesses fail. The statistics are very high. Most businesses fail within the first 3 years, first 5 years, so on and so forth. And in most cases, you're not going to get your money back. Sure, you want to support them, but it can be a losing situation. And worse than that, it can tarnish the relationship. So check this out. I've got a dozen or so case studies like this, but this was a big one. So one of my best friends, his father has a business in the industrial space. It's considered a small business, but it's well established. It's doing very well. It's been around for like 30 plus years. And his brother came to him and wanted to start a new business. Well, my friend's dad gave the brother $100,000 to start the business, and within I think it was 2 to 3 years, lost $100,000. Business went out of business. And the worst part about it, the friendship is ruined, and it's been ruined for like 15 years now. It's just a sad situation. I've seen that happen too much. So when I get somebody who's close to me that says, hey, Sean, hey, I've got this new idea. Would you invest in my business? My answer is no. I'll tell them, go to the bank. I'm not risking my money. I like you. I even love you, but I'm not risking my money. Go to the bank. They should be risking their money. I'm not risking my money. End of story. And if you got this situation right now, send them this video and just point it out that in most cases, money's lost, and even worse, the friendship is tarnished. All right, number 5 would be small cap crypto. I didn't say crypto in general, as some large financial institutions will instruct, try to invest 5% or less of your net worth in crypto if you do invest in crypto. Here at Tykr, we say the same thing, go 5% or less. But of course, if you do invest in crypto, try to invest in the big blue chip crypto coins, but definitely try to avoid the small crypto coins. I see this all the time, a new crypto coin coming out that's like, 30 cents, and people are like, this is definitely going to $30 in the next few years. It's like the new Bitcoin. Get in now, drive that price up. We're all going to be multimillionaires. That scenario rarely happens. So be very careful with these new crypto coins, and there's going to be a lot more coming out here over the coming years. Be careful. So again, if you want to invest in crypto, go 5% or less of your net worth and focus on the blue chip, the big names that we all recognize. Moving on to number 6, we're going to deviate a little bit here. Whole life insurance. I made the mistake of buying whole life insurance as opposed to term insurance well over a decade ago. I was paying $400 a month, and their pitch was, you're not only getting life insurance your entire life, but we're investing your money. Well, I started getting really good with Tykr, its first version, an Excel sheet, and I start seeing my returns like, 15, 20, 25% on up to 50% per year. And I go to these guys, I'm like, break this down. How much am I earning per year? And they were very apprehensive about giving me direct percentages, but I really pushed them. I said, what are the returns I'm getting per year? So they showed me a sheet, and it showed 6% year over year. Guys, I'm done. This is a scam. I see too many people pulled into whole life insurance. It's super high cost, and the returns barely keep up with the market. So I pulled my money out, invested it all, and I got term life insurance. I think it was like 25 or 30 years, lot lower cost per month. And it's just insurance. There's no investing mechanism that's over-engineered with low returns. So if anybody pitches you whole life, just say, not interested, but I would consider term life insurance. Okay, number 7, precious metals. I know some people go nuts about gold and silver, and those trends can go up and down like waves in the ocean. In most cases, precious metals do not keep up with the market. I avoid precious metals. I know, again, some people go nuts about it, but it's typically not an investment to even keep up with the market. Number 8, NFTs. So NFTs, I have never shown interest in. The reason is NFT is not a business. I like stocks because a stock is a business, and a business can have multiple streams of revenue generating profit for the company. Does an NFT do that? No. So for that reason, I'm out. When I hear about people talking about, I want to invest in an NFT, I think it can be worth a lot someday. In most cases, no. You might as well go to the casino, put all your money on black, and there you go. I'm being facetious here. I do not recommend going to the casino, but NFTs, same thing. Not a great place, not a reliable place to put your money and make decent returns. All right, number 9 would be art. Some people think that art can be a big ROI. Again, it's rare. Sure, you might find that one painting that it might increase in value over the next 25 years, but again, too much of a risk. And does art produce reoccurring revenue with multiple streams of revenue? The answer is no. For that reason, I'm out. Just like NFTs. I like businesses because businesses make money. Next up, number 10, jewelry. Some people think jewelry appreciates. No. In most cases, it does not. Sure, in some cases, but not a wise place to put your money. Again, doesn't produce multiple streams of revenue. Number 11, CDs. So CDs don't even keep up with inflation. You might as well put your money into a savings account and just let it sit there ready to deploy into your broker account for investing in stocks. Unfortunately, CDs, and I had a few CDs when I was graduating high school, they were locked in. I think it was locked into like 6-month or year-long terms where I couldn't do anything with the money. And at the same time, it was barely beating the interest rate of my savings account. It's just a horrible place to put your money. So I highly recommend avoiding CDs just because it doesn't even keep up with inflation. And of course, you can do a lot better if you're investing in the stock market, especially if you're using Tykr. All right, and then number 12, this is quite a deviation. That would be timeshares. I know people love investing in timeshares. It's a great place to get away, but there's a few negatives here I have to point out. Number one, you're landlocked. Like there's that feeling like, okay, so we have a vacation coming up. We also bought a timeshare. Well, we should probably use the timeshare because we paid for it. So there's this obligation that you have to go use it. You don't have that freedom to go anywhere else. Timeshares also cost money. They're not producing money for you. They're not generating reoccurring revenue. Real estate, I've talked about in other episodes. Real estate's great. A lot of people have made a lot of money in real estate. You know, real estate produces reoccurring revenue. So if you want to buy a location that you can go visit and travel to, that's awesome. You can also put it on like VRBO or Airbnb or find some way to rent it out when you're not visiting, so it's making you money. But timeshares, in most cases, it's a travel destination that's not making you money, so it's typically not a good investment. All right, those are top 12. I could create a list of probably 100 bad investments, but here at Tykr, you know the drill. We're all about investing in individual stocks, Warren Buffett style. And if you're interested in investing in the stock market, I do invite you to join Tykr for free. And if you're interested, I do have a free training down below. There's a link titled 3-Step Plan to Buy Stocks with Confidence. Thanks for checking out this video. We'll see you in the next one. Bye for now.